We can make a sound argument that this week's video will be the most important investing in stock market video you will ever watch, because the rarely covered concepts could help you avoid major missteps and clear up common 2020 misconceptions. In part one of the video, we'll be covering longer-term concepts that may be skewing your intermediate-term view of the stock market and economy. In February 2020, there are many factual, appropriate, and concerning topics to worry about. There are some concerning scenarios that may or may not come into play in the future, and thus it's important for us to keep them on our radar. And as we'll demonstrate in this week's video, there are numerous concerns in 2020 that history tells us are far from showstoppers when viewed in isolation. In the slides that follow, we're going to walk through 6 present-day concerns, and using facts, we will determine where they fall on the continuum on your screen. Number 1, stocks have been rising for 10 years. There is no way they will continue to rise for another 10 to 15 years. Number 2, aging baby boomers mean the economy and stocks are in big trouble. Number 3, after a 10-year run in stocks, bonds will significantly outperform stocks over the next 10 to 15 years. Number 4, and when we cover this topic, you will see some eye-opening charts. High valuations mean stocks will produce disappointing returns over the next decade. Number 5, earnings are peaking in a similar manner to what was seen before it got really ugly in the stock market in 2000 and 2007. Number 6, unemployment rates near 50-year lows tell us another 50% decline in stocks is just around the corner. Since we only know what we know, for the vast majority of stock market participants, this is how the stock market operates. Stocks rise for several years, and then we hit a stage of euphoria and really bad things happen. Center of the screen. Stocks rise for several years, we hit a stage of euphoria, and then really bad things happen. Therefore, we know, right side of the screen, stocks have been rising for several years. Thus, experience says it's only a matter of time before something ugly like this happens. 2 questions that we will ask and answer. What can we learn from history if we go back to 1925? And is it possible that we're all suffering from recency bias? We chose this title for the video this week not because we're going to make some grand forecast about what's going to happen in the future, but rather, to be successful in any environment in the stock market, we have to understand an extremely wide array of possible outcomes, from extremely bullish to extremely bearish. Clients and regular viewers know that we have a relatively recent and real-world example of those concepts. January 21st, 2019, this blurb here and this research in this post here basically told us to keep an open mind about better-than-expected outcomes walking forward from January 21st, 2019. Given the level of pessimism in January of 2019, having an open mind walking forward turned out to be extremely beneficial. So let's see if we can expand on our horizons relative to possible outcomes in the stock market walking forward. We've got a lot to cover, so we'll be moving quickly. This is basically an exercise in pattern recognition. S&P 500 weekly. After the 1929 crash, it takes a long time to repair the damage, and thus the stock market rallies off the 1932 low, but doesn't make a major and sustainable low until 1942. And in 1950, we get what's known as a secular breakout when price finally clears the orange consolidation box. And from a recency bias perspective, it would be very, very easy to look backwards here and say, this will turn into this, or this. But that's not what happened. The breakout was followed by the early stages of a new secular trend. Still very easy to understand why market participants were skeptical in here, given what they knew in the rearview mirror. That skepticism helped push the stock market higher. The secular peak after the secular breakout in 1950 did not arrive until 18 to 19 years later in 1968. From this point in here, January 1st, 1955, the S&P 500 gained an additional 201% and rallied for an additional 13.9 years. We're all familiar with the expression, the market needs to consolidate its gains, and that's exactly what happened. The secular trend ended. We went into a long-term consolidation period similar to this period here. The low in 1942, similar to the low in 1974. Secular breakout in 1950, similar to the secular breakout in 1982. I'm 53 years old. I lived this. I can assure you there was a high degree of skepticism about the future of the United States in 1982, which is very understandable from a stock market perspective, because looking backwards, this is what market participants knew. After the secular breakout, the stock market rallied, and this looks like the early stages of a new secular trend. Still a lot of skepticism here, which ultimately helped propel the secular trend higher. From this point here, January 1st, 1986, the S&P 500 tacked on an additional 623%, and from this window in here, rallied for an additional 14.2 years. All good things must come to an end. Secular trend peaked in the year 2000, went into a long-term consolidation box, very, very similar to this box here and this box here. In 2013, we get a secular breakout that's very, very similar to the secular breakout in 1982 and the secular breakout here in 1950. Despite a high degree of skepticism here, similar to skepticism here and here, the secular breakout held, and we have the early stages, early secular trend look stage here, similar to this look here and this look here. And if you're skeptical in the present day, it's very, very easy to understand that, because this is all you know. Your perspective can change significantly when you also know about this look and you know about this look. Very, very easy, given what we know today, to say stocks have been going up for 10 years. There's no possible way this rally will continue. Market participants were making the exact same argument here and the exact same argument here. 10 years from 1942, 1952, right here. 10 years from 1974, 1984, here. And having this type of attitude here and here turned out to be extremely costly and extremely frustrating, given this rally lasted for an additional 13.9 years and this rally lasted for an additional 14.2 years. What does history tell us about being skeptical or too cautious in the present day? Given this number here, 200%, and this number here, 600%, this table will help us answer that question. It will show the growth of $600,000 after earning 150% all the way out to 500%. Right side of the table will do the same thing with 5 million. If $600,000 earns 400%, I know that sounds crazy, but history says that is not crazy. It turns into 3 million. If $5 million earns 400%, it turns into $25 million, hypothetically. Once again, demonstrating the potential value of understanding a wide range of outcomes, rather than assuming in the present day that this is what's coming next. How long could this rally potentially last in the present day? 3 quick ways to do that on the back of the envelope. Using this figure here, 13.9 years. This figure here, 14.2 years. We can also project from the secular breakout in 1950, secular breakout in 1982, and in the 2 previous secular trends from the secular breakout, 1950, 1982, the market rallied for 18 to 19 years. Hypothetically, if we experienced a similar 18 to 19 year rally from the secular breakout in 2013, that would take us to the 2030-2031 window. Using this number, 13.9, 14.2, and 18, tells us it is absolutely positively within the realm of historical possibility that this secular trend will last until the 2030 to 2034 window. What about demographics? Do demographic trends align with or contradict everything here on the screen? Clients and regular viewers know the answer. It's firmly align with. The takeaway from all of this is that this window in here is similar to the 1984-1987 window and similar to the 1953 to 1957 window. What do the demographics say, keeping 1984 and 1987 in mind? The answer, the exact same thing. The demographic profile of the millennials in here is similar to the demographic profile of the baby boomers in the 1984 to 1987 window. What is a demographic sweet spot? It means the baby boomers were moving into their peak spending and earning years in here. And after that, really good things happened in the stock market for a really long period of time. The technicals say this window. The demographics say this window is similar to this window. We covered this topic in October of 2019. You can find the full analysis by Googling the title on your screen. Next up, asset class behavior. Does it align with or contradict the secular trend thesis and the demographic analysis? To answer that question, we'll look at the ratio of stocks relative to bonds walking forward from 1982. Given we just established that a major secular breakout occurred in the stock market in 1982, it's not surprising that walking forward from 1982, stocks were crushing bonds. And given everything that we covered in the demographic analysis and demographic video, it's not surprising that that trend lasted into the year 2000. The boomers are in the sweet spot here. In the year 2000 is when the oldest boomers started to leave the sweet spot. In the simplest terms, they're boosting the economy here, and they start to become a drag on the economy here. They're also getting older, and thus it's logical that the demand for more defensive-oriented bonds would pick up. If we walk forward, the ratio hit resistance in the year 2000, 2007, and in the same basic area in 2015. After a big move, this ratio needs to consolidate its gains, and that's exactly what happened for 17 to 18 years. And here, 2017, we finally have a bullish breakout, telling us that all of this firmly aligns with all of this. And it's always important to remind ourselves, even if everything plays out in this manner or this manner, we have to have realistic expectations about how the stock market works in the real world. Even if we get a move like this to this, or a move like this out to the year 2000, really bad things, including cyclical bear markets and recessions, can occur between point A and point B. It looks easy when you're watching this video. A 33% drawdown in 1987 was far from easy. Once again, underscoring the importance of understanding a wide range of outcomes, bullish and bearish. That allows us to maintain that all-important maximum flexibility and make decisions based on the data that we have in hand. If you're watching at home, you might say, Chris, that all sounds great. This is a really tidy analysis that you showed us on secular trends. I watched your demographic video and it's fascinating. In this chart here, I agree with you. That looks like a bullish breakout, stocks relative to bonds. However, you can take all of that, wad it up into a little ball and throw it in the trash can, because none of it fits with valuations. Feel free to pause your video player because we'll be moving quickly. This is the Dow between 1956 and the end of 1982. And the major takeaway here is you only know what you know. Valuations look really smart because hindsight is 20/20. after the major secular breakout in stocks on December 31st, 1982, if we look back over 100 years, the median Shiller PE was 14.83. Therefore, if we walk forward to the end of 1985, it would have been very, very easy to say stocks are expensive here. And when we got to 1986 and 1987, it would have been very, very easy to say stocks are expensive. If we're patient, we can buy the exact same stocks for half price because we had major lows here, 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 and here at single-digit CAPE ratios. So the million-dollar question is, if you were patient, how did that work out for you? The answer is not very well. In fact, so poorly that it could have ruined your career. You only know what you know. At the end of 1985, no one in their right mind would have guessed that the Shiller PE would have gone from roughly 14 or 15, all the way to 44. Now, here's the key takeaway. Very, very similar to this point here. We have absolutely positively no way of knowing that this is going to 44 based on what we know here. In the present day, you have absolutely positively no way of knowing what the median Shiller PE will look like in 10 to 15 years or the maximum Shiller PE. It all looks very, very easy with the benefit of hindsight. And relying on valuations could have been extremely costly. $1 million invested in this allocation here would have grown hypothetically to over $9 million at the secular peak. A PE of 44 is 198% above what we knew from a median PE perspective at the end of 1982. Unequivocally proving with a real-world example that valuations are absolutely positively a horrible timing tool. What is a PE ratio? Price and earnings. So PE ratios are affected by price and by earnings. What can we learn by looking at earnings? It's pretty easy to see the pattern of consolidation, trend, consolidation, trend, consolidation, trend on this chart. I think you can make a rational argument that the same concept applies to earnings. This is S&P 500 earnings, 1925 all the way out to 1950. We'll move quickly. Feel free to pause your video player. It's a long-term period of consolidation. If we draw a horizontal line, we hit earnings numerous times. Not discernibly different looking backwards 20 years from 2020. If I draw a horizontal line, I hit earnings several times. Hit earnings several times. This is the type of analysis that can lead to big, big mistakes potentially based on what we know in the rearview mirror. Earnings going above the upper Bollinger Band here is a it's all over signal. Very, very similar to what it looked like here before really bad things happened in the stock market. This is the look at the end of December 2019, above the Bollinger Band, and then we come back in going sideways. You can make an argument. It's very, very similar to this look here, above the upper Bollinger Band, and we come back in and go sideways. Then we break out. Would have been very, very easy to say it's over here based on this look here. We can also make an argument that this look here in earnings is a long-term consolidation pattern followed by a bullish breakout. Can also make an argument that this is a long-term consolidation pattern similar to this pattern here. You may be saying, wait a minute, inverse head and shoulders is a bottoming pattern. Peter Brandt once told me that can also be used as a continuation pattern. That's good enough for me. Studying charts for years and years and years, I agree with Mr. Brandt. What is a continuation pattern? Bullish trend, left side, consolidation, then we continue the trend. Since this look here, right here, is very, very similar to 1949, might be helpful to know what happened from a similar look in 1949, 1950 walking forward. Did earnings plummet similar to this look here? The answer is absolutely positively no, simply telling us to keep an open mind about a wide range of outcomes. In fact, in this case, not only did we avoid a plunge like this or a look like this, in this case, which is very, very similar to the present day, earnings never came even remotely close to any of these levels here over the next 50 years. Earnings went into a secular trend until the year 2000. These concepts here relative to earnings, and these concepts, factual concepts relative to valuations and PE multiples, give us a factual basis to respond to the common rebuttal. Chris, you are insane. With, or, am I so sane that I just blew your mind? Let's shift gears to the present day unemployment rate. Are we watching the unemployment rate in the present day? And will we continue to watch the unemployment rate? Absolutely, positively, yes. We believe the unemployment rate is and will continue to be helpful. However, some historical context may also prove to be very helpful over the next decade. This is what we all know. When the unemployment rate here, where my cursor is, gets very, very low and then spikes, we know really bad things happen in the S&P 500. And we've got more evidence to back that up. We know when the unemployment rate gets really, really low and then spikes, really, really bad things happen in the stock market. And given this is the look of the chart in the present day, it's relatively easy to make the case that we have a it's all over look on this chart. And we know it's only a matter of time before we see another 50% decline in the stock market. What can we learn if we go back a little bit further in time? You could also make the case that the unemployment rate is much, much lower in the present day than it was in the year 2000 and relative to where it was in 2007. And therefore, risk is even higher today. Let's see what we can learn from history. Present day unemployment rate, really the only period that's significantly lower, May of 1953. Therefore, recency bias tells us when the unemployment rate spiked from a low in May of 1953, any secular trend that was in place must have ended immediately. Therefore, it might be helpful to know, how did the stock market perform walking forward from May of 1953? The answer is extremely well. After this spike here, the S&P 500 righted itself here and tacked on an additional 341% and rallied for over a decade after a look like this, simply telling us to keep an open mind about a wide range of outcomes. It's very, very easy to look at a chart like this and assume that it's going to be a cakewalk walking forward in the present day. We all know better than that. It's not the way the market works in the real world. Very satisfying gain from point A to point B. No cakewalk in between. We covered this earlier in the video. It's important to keep covering it. Without realistic expectations, it's going to be very, very difficult to navigate between a point A and a point B that could be several years down the road. If you're new to the videos, you can pause your video player. Might be helpful to know. You can visit our website and click on the FAQ link for a wealth of information. And if you're looking to add some independent and creative thought to your investment game plan, you can contact us via email. Now let's shift gears to part 2. And we'll be covering shorter-term concepts that can help us monitor bullish and bearish developments walking forward. Since this portion of the video is much more tactical in nature, we'll be moving quickly. We're covering all of this to help clients understand what's written inside of this box here. Here's the AD line, February 4th. Nothing particularly alarming here. This is what happened in the stock market. Similar concepts here. Holds, S&P 500 holds. Holds, S&P 500 holds. Holds, S&P 500 holds. Present day look is also very, very constructive, similar to this look here and this look here. Just providing a handful of examples. Another breadth indicator. Given what we know today, the two best recent analogies for the stock market are early 2013 and early 2017, late 2016. Therefore, we would like to see this indicator hold above the green lines, and we would like to see this indicator avoid a look like this and avoid a look like this. So far, it bounced at a logical level. If all of this is accurate in the present day, we would expect to see some long-term bullish setups on DeMark charts. DeMark charts and indicators are proprietary tools from Market Studies, LLC. S&P 500, this is an annual chart. We're looking at a combo count. This is a 9 and 13. It's potential trend exhaustion. It turned out to be pretty helpful. The solid line tells us that the market has negated the 9 and 13. This tends to be bullish from a probability perspective. This is what happened after the line turned solid. As you can see, dating back to the 1920s, this has only happened one other time, 2016. Hard to argue that this does not support everything that we've been talking about. Exact same concepts here, a little bit different approach. Only happened two times. Q2 of 1992, this is what happened in the stock market after that. Similar setup here, Q1 2019. Probably wouldn't be an exaggeration if you called this ratio the mother of all inverse head and shoulders patterns. This absolutely positively aligns with everything that we've been talking about since January of last year. Like every chart, we'll learn something either way, either bullish or bearish. Same concepts back to DeMark, XLK, technology sector ETF. Daily count gets negated here. Tech does well. Similar situation here, just negated. DeMark has 4 major counts. All 4 major counts for XLK have been negated. All of this leans bullish from a probability perspective. The concepts are identical to the concepts here, just on a different time frame. Speaks to fractals. If you know your market history, you know it's a good thing if the present day looks like November of 2016. Defensive staples versus the S&P 500. You can pause your video player. Present day does look a lot like this period here. And this is what happened in the stock market. Similar situation here, XLK relative to TLT, tech versus bonds. Very, very similar look. November 2016, similar look in the present day. Many of the charts that we looked at a week ago Saturday told us that this looks like a bullish breakout. The 2-week decline that we had looks like a retest. We'll learn something either way. We don't use any of these charts to forecast. This look here and this move here speaks to the probabilities here, which are quite a bit different from certainties. If you know your market history, 2009, 2011, 2016, all bullish periods for the S&P 500. Hard to argue that XLU relative to SPY in the present day looks discernibly different from those periods. SPY relative to IEF, what once acted as resistance may now act as support. We'll learn something either way. CCM market model uses a weight of the evidence approach. This looks like a bullish breakout, a retest, and a second retest. This breakout here comes back and retests the orange line right where my cursor is. This is almost a little mini fractal of that. This looks like a bullish breakout, and thus far a successful retest. NASDAQ versus the S&P 500 after the U.S. election here. It looks similar to this look here. We drew this line here before the stock market opened this week. So far the indicator is holding the trend line. Nothing particularly alarming on this chart yet. We'll learn something either way. Another chart looks like a bullish breakout and a successful retest. Outcome still to be determined. Stocks versus bonds monthly. It's a familiar looking pattern, isn't it? Market needs to consolidate its gains, bullish breakout. This looks very similar to this and looks very similar to this. If you Google our last name, the name of our blog, Short Takes, and the word DeMark and recycled, you can find what we believe to be a still very relevant and helpful analysis dated November 16th. In closing, recency bias tells us it's logical to think that this is what's coming next. But we have a mountain of evidence that tells us to keep an open mind about better than expected outcomes walking forward. The only way any of this works, if we head into next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue.